Good afternoon, everyone, and welcome to our Q1 2021 Credit Trends webinar. For those of you who haven't met me before, my name is Becky Oakes. I look after the Analytics and Data Science team here at Equifax, and I'm delighted to say I'm joined by our Consumer Insight Lead, Swanama Pandey, who's going to be helping me talk you through the recent trends today. Now, as always, we do have a lot of information and insights to share with you. So we're going to be doing a lot of talking, but hopefully we're going to break that up with a few polling questions for you and also taking questions along the way via the Q&A box. Before we get started, I'm going to hand you over to Sandra, who's going to talk you through how the platform works. Sandra.
Good afternoon, everyone, and thank you, Becky. Today, you will see a Q&A widget that Becky mentioned on the left side of your screen. Feel free to enter any questions you may have, and we'll address them throughout our session. In the event there are too many questions to get through, we will generate an FAQ document, which we'll send out to you in the coming weeks. Today's presentation is available in the resource widget for downloading on the right side of your screen, and some other documents may be pertinent will be available in the next few days, as well as our French presentation. The slides today are shown in the middle of your screen. As well, our session is being recorded today, and you'll receive the on-demand link via email tomorrow. We have a short survey, which we'd ask you to fill out at the end of our session today. It will automatically pop up at the end of the webinar. Otherwise, you can click on the survey icon at the bottom of your screen. To the right of that survey icon is a help button in case you have any other questions. And otherwise, let's get started. And Becky, back to you.
Thank you, Sandra. So as always, we are going to start very briefly talking a little bit about the Canadian economy and how things have been shaping up since the pandemic started a year ago. So if we start with the backbone of our economy, which of course is employment. Now, as we all know, April to June last year saw huge drops in employment levels, especially for part-time workers. And this, of course, was linked directly to that first wave of COVID-related lockdowns. Now, things have been improving since then, and full-time employment, which is the blue line on the chart, that's gradually been increasing and is returning close to those pre-pandemic levels. Part-time employment, however, has seen a few more challenges, and we see impacts with every wave of new lockdowns come through on that part-time employment level. Now, this really spans across many different industries, but we saw large falls in areas such as retail, hospitality, restaurants, tourism, and this is where we expect to some degree to see continued uneven recovery from an employment standpoint going forward. So if we dig a bit deeper on this, Stats Canada provided a really nice spider or radar chart on the change in GDP across multiple sectors between February and December last year. If you look at this right-hand diagram, the green line on the outside is the position as of February last year. The blue line is at the end of December, and the red line highlights the maximum decline that we saw during the period. Now, whereas some industries such as utilities, agriculture, kind of finance and insurance, and even real estate saw very little decline through last year, and they were protected to some extent from the pandemic impact, others saw incredible drops, such as in arts, entertainment, accommodation, food, retail, construction. And the important thing here is that the extent of the recovery in these groups, whereas some like construction have rebounded well and are almost back to those February GDP levels, others, like the food and entertainment industry, are still not really seeing this return to normal yet. Now, this really remains a large risk area for the Canadian economy, as long-term decline such as this isn't really viable for businesses without significant support mechanisms being in place. Now, there are, of course, a lot of jobs linked to these industries, and therefore this puts additional risk on those groups of individuals, and they tend to be more those part-time workers at the lower end of the income band, and typically sometimes younger individuals as well. So this is kind of a key area of focus for us over the coming months. Now, there are some good news for many of these consumers in the form of those government support mechanisms that have been in place. If we take a look at the left-hand chart, this shows the change in average household disposable income split by different income bands. Now, so the bottom of the chart, you'll see the lower income quartiles, and the upper ones are the higher income. In the second quarter of last year, you can see on the orange bands the large increase in household income for those lower income groups. And this is likely a combination of reduced spending, so due to those lockdowns, perhaps they weren't going on vacation, they were kind of saving a little bit more, but it's also in some cases due to actually an increase in income, sometimes from the actual government support mechanisms themselves. Now you can also see the impact of the Q2 period on the right-hand chart, which shows household savings. So this did reduce a little bit towards the end of last year, but we do see that big bump in terms of what happened in Q2. So what does this all really mean? Well, really this is showing three things of interest to me. Firstly, individual consumers are still in a reasonably good place financially for the moment, and that's likely due to the government and lender support that has been given since the pandemic started. Secondly, from an employment and business standpoint, there is clear uneven recovery and there is continued potential to see closures and job losses in certain industries. And that's something we've also seen echoed in our commercial database. So we're seeing reduced credit activity across certain sectors, and that's not really a good thing for businesses normally. And finally, whilst the government stimulus is still in place, consumers may still be maintaining a relatively stable financial position. But if and when these end, and if some of these industries haven't fully recovered, that could translate into increased risk of credit delinquency for some groups of consumers. Okay, so that's kind of what's going on a little bit high level on the economy side. So let's step into what we're seeing on the credit industry side. Now, unsurprisingly, the high level numbers really support what we've seen in line with the economy side as well. And for the most part, things are looking fairly good right now. The average non-mortgage debt is still down more than 4% year on year, and despite some of those deferral programs ending last year, delinquency is still well below pre-pandemic levels. But there are two things I really want to call out. So the first is the housing market, and Swanham is going to be talking to you about that in more detail later on. But this has seen continued growth despite the pandemic. Secondly, insolvencies. Now, the good news is that levels of insolvencies are still down year on year. However, what I do want to call out is that in March this year, we saw the highest volume of insolvencies for 12 months. There are certainly some pockets of increased stress starting to come through, and in some cases, we aren't seeing early warning signs. So normally we would see delinquency increase before insolvencies. In some cases, that isn't occurring. So in terms of the main trends we're going to be discussing today, the housing market is, of course, a key one. We've seen very hot markets in areas such as BC and Ontario, but the big question, of course, is what's going to happen and how is that going to get cooled down over time? Is the increased stress test going to be able to cool that market? Another area of concern lays around whether there may be a need to eventually increase those interest rates. And as a result of inflation which is going on, that could happen potentially earlier than intended, and that could have a larger impact at calming that housing market down. Secondly, and we've mentioned this kind of throughout the pandemic, consumer spending and credit usage has changed dramatically over the last 12 months. So credit card balances are now at the lowest for 6 years. And then finally, as I mentioned a few minutes ago, that increase in bankruptcy that we're starting to see come through for some consumer groups does kind of keep in line with this K recovery that might be occurring. So in coming months, we may start to see some consumers recover well and others may start falling into difficulty. So at a very high level, consumer debt reported to Equifax stood at almost $2.1 trillion at the end of March. And again, that growth in that balance is really coming from mortgages, which were up almost 8.5% year on year. Non-mortgage balance, on the other hand, fell around 4% in Q1. Now, if we look at that at a main product level, which is on the right-hand side, what we see is that year-on-year falls across all products, with cards and unsecured lines of credit seeing the greatest movements. The only real increase in balance we've seen is actually on bank loans, and a lot of that increase actually occurred towards the middle and end of last year. In Q1, we're actually seeing new loans fall a little bit now. So if we look at delinquency, overall, we are still at levels below those seen in the pandemic, pre-pandemic. So that left-hand chart shows our 90-plus day non-mortgage balance delinquency rates. Now, what this means is that's the percentage of balances where payments are more than 90 days past due. So you can see in that grey area, which is when the pandemic kind of really hit, the dip in Q3 2020. And that was really due to some of those lender support mechanisms like deferral programs coming into play. If you joined us last quarter, you remember that we'd called out some early delinquency starting to come through towards the end of last year when those programs started to end. Now, the good news is that for the most part, that really has started to stabilize. And you can see kind of a flattening of that curve. So if you look at that left-hand chart, that dotted line is that overall delinquency level. So it did come up a little bit in Q4, but it has fallen back down again in Q1. Now, if you look at the orange and yellow coloured lines on that chart, these are some of the younger consumer age groups. And what we would like to call out is that we are starting to see a little bit of an increase come through on those younger consumers in terms of delinquency levels. So they're starting to go up a little bit. And where we are seeing that is really on bank loans. And if you look at the right-hand chart, this is the change in delinquency for different products, either quarter on quarter, so Q1 compared to Q4 last year, or year on year in green, which is compared to the same period last year. And what we're seeing is that everything is down with the exception of those bank loans. And again, that 11.6% increase quarter on quarter, that's driven by those younger consumers. If we look at this across a geographical or provincial level, it's really a similar story that we're seeing on the non-mortgage side. So delinquency is still lower everywhere compared to pre-pandemic, but there is some variations in terms of the extent of this drop. So if we go back prior to COVID, we did see some early warning signs starting to come through in Alberta, where we saw some increases in delinquency levels, some financial stress starting to come through. So it might be no surprise that what we're seeing when we look at the levels now is that Alberta has the smallest decline in terms of their delinquency rates overall. Quebec, on the other hand, actually is in a much more positive position. They're seeing some of the biggest drops in terms of their delinquency. So we are starting to see this unevenness come through, not only within certain demographics when we're looking at some of the younger consumers potentially seeing a bit more of an increase, but we're also seeing to some extent this at a regional level as well. Now, insolvency-wise, as I mentioned earlier, we typically see a direct link between increased delinquency and increased insolvency. Now, we first saw this start to separate in late 2018 and into 2019, where we had interest rate rises that led to increased insolvency for some consumers, in particular with things like large variable rate balances like HELOCs. If you look at that left-hand chart, that red line is the bankruptcy rate and the grey line is the 90-plus delinquency rate. And you can see that separation starting to occur the back end of 2018 into 2019, where we have a bump in the red line for the bankruptcy level. So what we've seen in terms of what's happened in 2020 is that although we saw a large drop in bankruptcy rates in Q2 and Q3 last year, which you can see on the red line, that has now started to pick back up again at a much faster rate than the delinquency levels are. So we're starting to see some insolvencies come through to where we're not really seeing the early warning signs from a delinquency standpoint. Now, the good news on the insolvency side, though, is that the fall in non-mortgage debt that we've seen across the board has meant that the average balance of insolvent accounts has dropped for the first time since 2015. It's currently sitting a little bit over 41K. And again, there are some regional movements in terms of quite what's happened, which you can see in that table on the right-hand side, where Quebec, for example, has seen that drop almost 8% versus some of the other regions where they're perhaps a little bit lower. So a couple of additional things I want to call out before we start to dig a bit deeper into some of the product-specific movements. Firstly, I wanted to touch on the deferral population. So we have done a lot of analysis into this over the last few quarters. And what we've been looking at really is what's happened with those consumers that took a deferral as they've exited those programs. Now, as you mentioned last quarter, on the credit card and installment loan side, we saw delinquency levels start to increase for that population. So those consumers that had taken a deferral and then exited from them, we started to see their delinquency levels move above pre-pandemic levels for those consumers. And you can see that on the chart. The left-hand side is credit cards. The right-hand side is auto and installment loans. And that red line kind of shows the delinquency level for those deferred consumers pre and post the actual deferral occurring. The dotted line is the overall population. Now, the good news is that although we did start to see this increase, and you can see that with the sharp uptake, it has started to level off again. So we are starting to see that start to level off and drop back down. So hopefully the initial bump of delinquencies that we saw as a result of those programs ending has now reached its peak, and we're kind of expecting that to level off and perhaps fall back down again. Now, the interesting thing, of course, is going to be what happens when the government programs fully stop as well, because they are still supporting some of those populations that probably really need it right now. So again, those lower income part-time workers where perhaps some of the employment side maybe isn't as stable going forward. And then finally, just to share a few statistics on the overall impact to consumers in the last 12 months compared to the previous year. So what we have seen is that there's 26% more consumers that have actually reduced their credit usage last year compared to the prior year, which is a real positive movement in terms of how consumers are using credit. We've seen 13% more recover from financial stress or delinquency, so where they've actually were perhaps missing payments and now they have recovered. And again, a lot of those are going to be impacted and helped by those support mechanisms that both the lender and the government have had in place. We've seen 22% less consumers increasing credit usage, so a much reduced amount of people actively spending more and kind of increasing their debt levels. And we've seen a huge 33% drop in the consumers moving into delinquency. So again, this really cements that this is a really quite an unusual economic period, but so far consumers are generally faring fairly well in terms of the actual overall level. Okay, so I'm going to step into credit cards unless we have any questions yet. Swanima, has there been any questions?
Not yet. We haven't had any questions as of now.
Okay. If you do have any questions, please do send them in so we can hopefully answer them for you. So let's jump into credit cards in terms of what we're seeing there. Now, we've talked a lot about what consumers have been doing over the last 12 months. And credit cards is one of the ones where we saw a dramatic drop in terms of the debt levels. And that's primarily in Q1 and Q2 of last year, but we are also seeing it start to decline to this year as well. So if you look on the left-hand chart there, those grey bars, that is the credit card balance, and the red line is the utilization level. So you can see that big drop occurring at Q1 last year. The largest movements we've seen have actually been on high-risk, the lower scoring consumers as well as younger consumers. And this likely links to some extent back to the economy section, when we saw that large rise in disposable income for those income groups, combined with some of the reduced places to spend and things during lockdowns. That's kind of really contributed to kind of what we're seeing in terms of this drop in credit card balance. The key reason behind some of these low balances, now as obvious as it may seem, is payment exceeding spend. So on the left-hand chart, you can see average payment in red, and you see average spend in grey. Now, where the red line is above the grey line, that means that people are paying more than they are spending. So seasonally, Q1 tends to see payments exceed spending, and that's really because consumers start to pull back a little bit post the holiday season in kind of November and December. But as you can see in 2020 and in 2021, that gap between the red and the grey is much higher than we normally see, and that's really where this balance drop is coming from. The good news credit card wise is that unlike in 2020, average spend has actually recovered a little bit. So going back to March, April time last year, where we saw that huge drop in terms of average spend, we are back a little bit closer to normal seasonal levels. If we look at this demographically, normally in Q1, most age groups do pay more than they spend. And that right-hand chart shows this in terms of the last 3 years of Q1. You can see generally it's below the line, which means that you are paying more than you're spending. The exception to that actually tends to be younger consumers. So if you see that Gen Z area, you'll see in 2019 and 2020, they were still spending more than they paid in Q1. That actually has reversed completely, and actually now it's the other way around in 2021. So we are seeing a huge shift, not only in terms of spending, but also that ability to keep paying down more on their credit cards. So why do we care so much about payment ratios when we're looking at credit cards? Well, as you may expect, payment rate is generally inversely correlated to delinquency. So what that means is if payment rate goes up, delinquency tends to come down and vice versa. So the biggest shifts we've seen in terms of change of payment rates are on those lower income individuals. So if you look at the left-hand chart, this shows you kind of how that relationship works in terms of when the red line payment rate goes down, you tend to get the delinquency, which is the grey line, go up. And if you look at the right-hand side, this is the change in payment rate that we've seen year on year in Q1. And it's rank ordered by income, household income. So you see the largest increases we've seen in payment rates, again, are on those lower income consumers, which is very positive. But again, it may all still be linked to that government support really helping them through this period. So if we kind of move on to think about the demand for credit cards, new card growth is much lower than we were seeing pre-pandemic. That left-hand chart you can see is our credit card, new credit card volume as the bars, and the line is credit card inquiries indexed back to Q1 2015. So what that means is this is kind of just looking at the change in terms of the number of inquiries that we're seeing at the Bureau come through for credit cards. And you can see that steady decline all the way through into 2021. But there are a few things driving this lower growth. Firstly, increased disposable income and savings. That probably means there's less need for credit to support spending. We've also seen an increase in debit card usage that's been reported, again linked to consumers potentially having more ability to just make payments from their bank account as opposed to being as reliant on the credit side. There's also an increasing variety of options available to consumers other than credit card, and that's creating some competition in the marketplace. That could be in the form from non-traditional lenders such as online providers or e-wallets and things, but we're also starting to see this increased demand for the likes of buy now, pay later, where you have kind of retailers working alongside the buy now, pay later companies to offer different payment mechanisms for consumers. Now, as more consumers have been shopping online during the last 12 months, that makes it easier and more prominent for them to access some of these methods as well. Now, in Canada, it's still a little bit early to see the full growth of the likes of buy now, pay later. So what we did want to share with you today is what's happening in another geography. And in this case, we're going to show you Australia. So this chart actually is what's happened in Australia since the start of 2018. And we've indexed the credit inquiries coming through at different products back to the start of that January 2018 period. So what you can see is the red line. This is the growth of buy now, pay later. So you see that large increase in terms of almost doubling the levels within the kind of a 18 or 15-month period. You can see the credit card decline post the pandemic. So that green line started in March. You see that decline similar to what we're seeing here in Canada come through. Actually, we have kind of mortgages has increased, which is actually the grey line. I think that's labelled incorrectly, but that grey line is actually mortgages. So we're kind of starting to see what's happening in other geographies. And that's something that we're going to be very closely monitoring over the coming months and see how is that impacting their credit card market, and in particular, kind of how is it competing against those. That's something we're going to be keeping an eye on and sharing with you over the coming months. So just before we do a quick poll, because I'm kind of interested to get everyone's views on the credit card market, I do want to share just a few thoughts in terms of key things you might want to be thinking about at the moment. So opportunity-wise, eventually, fingers crossed, these lockdowns are going to fully end. International travel, tourism will hopefully pick back up again as our borders start to reopen. And I highly suspect that many of us will want to welcome that period back once confidence has increased again. And we may see increased spending, especially on things like vacations, which are often financed by credit cards. But there is that opportunity that actually the credit card, although we've had some very low balances, that could start to pick back up again. But now at least delinquency is low, and that can provide growth opportunities. So as you start to see reduced bad debt levels come through, that potentially gives opportunity to deepen kind of some of the offers that you are going out with. And finally, if you're a credit card provider, there's great opportunity to really start targeting some of your marketing activities as the economy reopens to help put your card front of wallet. So that's some of the opportunities, but what about the risk side of things? Well, with lower demand for new credit cards and the increase in things like buy now, pay later, that's going to mean we are going to see more competition probably in the marketplace. So it's really around how you're going to adapt your strategy so that you avoid kind of your growth being stalled by some of those things. The other thing to call out is that potentially as that government stimulus starts to be pulled back later in the year, potentially, we might start to see pockets of stress come through. And it could be that the increased demand you get initially may be some of those consumers who perhaps are more stressed than others. So again, keep an eye on that K-curve recovery, thinking about how you segment as consumers are coming to you looking for additional credit to really make sure that you are offering your credit in line with kind of what the consumer can actually afford to pay back. Okay, so I've talked too much already. What I'd love to know is we have 4 options here in terms of what factors are having the greatest impact on your credit card business. We're hoping that you may be able to choose 2 of these and we can see some results on this. If you'll take a few minutes and see if we can get some. Okay, so I'm starting to see a few come through. Anybody else would like to select any? So right now we're seeing consumer spending behaviour is probably the biggest concern. Interestingly so far, I'm not telling you buy now, pay later. Okay, so there we go. So it looks like buy now, pay later actually isn't like a big concern right now, which is interesting. But we will keep monitoring that over the coming months in terms of what we're seeing in those other geographies. Okay. So the other non-mortgage product I wanted to step into before we get onto the mortgage side is the auto market. So 2020 was a bit of an unusual year on auto, as the seasonal peak we normally see on auto tends to be in Q2. And that didn't really happen because we had COVID and we saw a large amount of lockdowns and things. So what we did see was a big jump in activity during Q3, which you can see on that left-hand chart, which kind of shows that increase come through. Now, the good news on the auto side is that overall financing has returned back to pre-pandemic levels, but we have seen a bit of an interesting shift in terms of consumer behaviour. So what we're seeing is a return to increased lease activity over loans. The new lease trades were up 21% year on year in Q1 versus a 1.4% drop on the auto loan side. Now, if you look at the right-hand side, this shows the percentage of those auto finance balances that come from lease activity, and you can see it's close to 40% on the new lease side of things, that jump in orange on the right-hand side. Now, in terms of the drivers behind this, there are probably a few things at play. Firstly, a lot of the leasing can come from small business owners, which we know was impacted heavily last year. We also saw a challenge with supply last year in the auto industry, leading to increased car prices and in some cases some challenges in getting the actual number of vehicles coming through. But one of the main likely drivers actually is interest rates. So we've seen average interest rates on leases fall over the last few months. Now, as a consumer, if you can get a low rate on a lease vehicle, this can make that option a lot more appealing. We also saw that in general, consumer credit scores increased last year. So what we're seeing is that potentially that's given some consumers the ability to access some of those preferential rates. And we're actually seeing on that right-hand chart, you can see where we see the biggest growth on the auto lease side is in those kind of prime, super prime populations. The delinquency side on auto has also been quite interesting. So unlike bank loans, there weren't many deferral programs offered or leveraged on auto financing. So although delinquency levels benefited last year from these being offered on other products, we haven't seen the same sudden drop in terms of the delinquency like we did on, say, bank loans. You can see that on the left-hand chart where the grey line is the bank loans and the red are the auto loans. So you see that large drop in the grey line, and that's really caused by some of those deferral programs being put in place. But even though the increase on bank loans wasn't that widespread, if you break this down by age group, which you can see on the right-hand side, you can see that it's younger consumers driving that increase in delinquency again. So this really does remain a concern because, again, if we go right back to the start of the session, you'll remember that uneven recovery on the economy side where part-time workers who often tend to be younger and perhaps more at risk once the government program ends potentially might see some stress come through later in the year. So it's definitely one to watch. So just to kind of summarize up again on the auto side of things, As with credit cards, demand may continue to increase once the economy reopens, which is the positive. We may also see small business owners start to take on new auto loans as the economy starts to recover further. The low interest rates may also mean more demand for consumers because now kind of leading to additional growth opportunity. But there are some risks. So consumers have been saving, they have more disposable income. That could mean a fall in the need for auto financing, or at least a reduction in the loan amounts in the short term. It could also mean you might get some negative bias in the adjudication population or the population coming through, so that's something to account for. At the same time, car prices have been increasing over recent months, and again, that's partly linked to some of the reduction in manufacturing last year, but that may make consumers more price sensitive in the short term as they try to get deals to account for those rising prices. And then finally, the thing to think about is what's going to happen if there are new pockets of risk that come through. So we're already starting to see that increase in delinquency in the bank loan side for younger consumers. We know on auto loans we were seeing increased delinquency prior to COVID. So it's unlikely that once government support starts to pull back that's going to help that situation. So there could be some delinquency that starts to creep in there. Okay, so before we move on, I'm going to take a quick pause and see if there's any questions that we have come through. Swanima? Swanima?
Sorry, I was on mute. Yeah, there's one question around buy now, pay later. So have you seen increase in total spend or proportion of dollars in spend, like decrease in spend areas where cards are used more as opposed to areas like retail offer payment plans?
Yeah, that's a great question. So I think one of the challenges we have in the Credit Bureau right now, and I think this applies to other geographies as well, is that buy now, pay later isn't fully reported as widely as we would like to enable us to be able to kind of give more indication on exactly what that spend looks like. So the slide I showed you before, that was inquiry. So that is where the buy now, pay later company is kind of making a call to the Credit Bureau in Australia for that request for lending to go out. So we're seeing it in terms of the inquiry levels. We haven't yet got much information in terms of exactly where that's coming from, but we are doing some work with the US as well right now to look into that a bit further. So we definitely will be coming back to you over the coming months with some more information on that. Any other questions? I do see one. Why do you feel there were less deferrals in auto portfolios? So generally speaking, it's difficult to kind of say in terms of on the bank loan side, because often bank loans are reported as auto, and we know there were more deferral programs offered with some of the major banks and financial institutions. In terms of some of the captive market, we just didn't hear about them coming through. We didn't see them come through in terms of flags in our system. They weren't reporting deferrals, and we did see less movement in terms of those deferrals. But saying that, again, the vast majority of the deferral population, there's kind of two camps. There was consumers that had a mortgage, and if they took a mortgage deferral, they generally didn't defer on other products as well. So you have the homeowners who needed to defer. They tended to do it on that larger chunk of payments going out, which was the mortgage side. And then we have kind of a different non-homeowner population where a lot of those were kind of really focusing on loans and credit cards, and we didn't see it come through on the auto loan side. Okay. So what I'd like to do is hand over to Swanima so that she can talk to you a little bit about what's going on in the mortgage market.
Thanks, Becky. Let's talk about mortgages. So housing has been a key driver of credit growth in recent times, and it has mostly remained unaffected by the pandemic. House prices have been increasing, which kept pushing the average mortgage loan amount up every quarter. This quarter, there was a 20% jump in average new loan amount when compared to the first quarter of last year. And despite the rising house prices, we saw a 41% increase in new mortgage volume when compared to Q1 2020. It is exceptional as this defies the seasonality that we see in mortgages. Usually, new mortgage activity tend to slow down in the first quarter of every year, but this year we have not seen a similar drop. Clearly, low interest rates are acting as a catalyst for new mortgage growth, with many consumers refinancing mortgages at this point in time, as no one wants to miss out on low interest rates. But even with low interest rates, affordability is becoming an issue for some segments, especially first-time home buyers, as their share of new mortgage volume shows a steady decline since the last half of the 2020. So if the house prices continue to go up, first-time home buyers will find themselves being priced out of the very hot housing market. Now, much of the new mortgage volume is coming from BC and Ontario, where we saw an increase of 59% and 44% in new mortgage volume year over year. However, if we look at the average loan amount increase, it has increased similarly across all provinces. So this indicates that the surge in house prices is no longer restricted to just BC and Ontario. Average loan amounts for new mortgages have increased all over the country. There's also a shift in low-risk customers. Overall, we have seen consumers have improved their credit score, and in this quarter, close to 60% of all new mortgages were approved for 750 plus score bands. So low score groups will find it difficult to get a mortgage as lenders are leaning towards low-risk consumers. A lot of new mortgage growth can be attributed to the pandemic and lockdown, which have had a big impact on consumer buying behavior. More consumers switched houses in the middle of the pandemic. Higher than average movement was seen between provinces and cities, with many consumers leaving bigger cities and moving to smaller cities. They're either being priced out of bigger cities or they're moving to smaller cities for bigger space and taking advantages of flexible work from home options. We have seen that maximum home switching behavior was shown by older consumers, so consumers greater than 45 years of age, many are moving out of bigger cities. The chart on the right shows the year-over-year change in the percentage of migration among new mortgage buyers. So mortgage volume increased by 8% in 2020 when we compare it to 2019, but the provincial migration increased by 22% from 2019 to 2020. So consumers have adapted and changes their needs with the pandemic-induced lifestyle. This has affected some provinces more than the others. Like, for example, Ontario saw a lot of attrition, people moving away from the province. There was also a lot of movement within the province, 37% higher average migration from Toronto to GTA, and even more migration from GTA to other cities. So whether this is a market shift or a temporary trend, that remains to be seen. When it comes to delinquencies, we have avoided the mortgage deferral cliff so far. Delinquencies have never been so low. The drop in delinquencies have been seen across all provinces, regions, and age groups. And mortgage deferrals are the primary reason for lower delinquencies. 14% of mortgages deferred payments, and they had an option to defer payments for 6 months. So we are starting to see a rise in delinquency in some areas, like Vancouver and Fort McMurray, but levels are still volatile. Some of these increases may be artificial, triggered by a bigger drop in delinquency in Q1 2020. Hence, the year-over-year increase looks bigger for Vancouver. However, for Fort McMurray, the increase may not be temporary, as they've had a much bigger delinquency rate pre-pandemic than most cities. So hence, we should gear up for an uneven recovery. We have also been tracking the performance of deferred accounts since they started deferring payments. So point 0 in the chart is the point from which they started deferring payments. And for non-deferred accounts, we have considered 0 as March 2020. So almost 98% of mortgage deferrals have ended. And we see a big increase in 30-plus delinquency in the 7th month, just when the deferrals ended, which in turn translated to 90-plus delinquencies in the 9th month, as accounts continued to miss payments for 90 days. But after the initial 30-day spike, we are seeing that the delinquencies are leveling down, but we still have government stimulus in place, and which is helping people to pay down their mortgage debt. We do anticipate a drop in mortgage delinquency in the next few months before we start seeing an actual rise after the government support ends. The deferred balance is pretty low when compared to the total mortgage balance. Hence, the delinquencies have not yet affected the overall delinquency. To track the impact of delinquency, we have also been monitoring delinquencies of other regions like Australia and New Zealand, which have been ahead of us in their recovery. In this chart, we have indexed all delinquencies at March 2020. They are indexed at 100%, and you see that similar trends is seen between Q1 to Q3 2020 during the 6-month deferral period. And as soon as the deferral ended, we see a spike in delinquencies till Q4. So this is where the common trend ends. And as we move into Q1 2021, we see that Australia and New Zealand have started to see increase in delinquencies as their government pulled back government incentives and now have replaced it with more targeted support. But for Canada, we still have government stimulus in place that is helping consumers with their payments. So based on what we see for other regions, we expect delinquency levels to rise to pre-pandemic levels once the government support is taken back. So new mortgage growth and lower interest rates have also given rise to HELOCs, home equity line of credit. We saw a 47% year-over-year jump in new HELOCs in Q1 2021. It's the biggest jump since 2015. So most new HELOCs are primarily driven by high-score consumers, but the risk on HELOC payments still remains as it is a variable rate product. And the monthly payments will keep increasing as Bank of Canada increases the rate. And we have seen in 2018 when the interest rate started to go up, a lot of consumers, especially older consumers, started filing for bankruptcy and consumer proposals. And this was triggered by HELOC balance where consumers couldn't make monthly payment after the interest rate hikes. To sum up mortgages, we can look at risks and opportunities associated with mortgage growth. So there's a lot of potential to grow as international borders open up, immigration ramps up, we'll see an increase in demand for housing, which will further accelerate mortgage growth. On delinquencies, we have seen that delinquencies have been low despite consumers getting out of deferral programs. That means consumers have resumed regular payments and have improved their financial situations. However, we're starting to see a K-shaped recovery as some pockets are still financially stressed, and despite the pandemic and despite the government support, they are still unable to pay their mortgage debt. Another concern is the speculation around the inflation and early rise in interest rates, which puts a lot of consumers in tough spots, especially ones with variable rate products. We'll continue to monitor mortgages very closely and provide an update of the housing market in our next webinar. Next, we have a poll on what factors do you find most concerning regarding the Canadian housing market. You can vote for 2 options: housing affordability, interest rate increases, urban-rural migration, or overheated markets. I'll give everyone a couple of seconds. So 80% of people are concerned about housing affordability, and 40% are concerned about interest rate increases, and another 40% are concerned about overheated markets. So multiple factors will affect the housing market in the near future. And for more information on housing market, you should join us for our webinar on June 29th, where Bill Johnson, SVP and Chief Product Officer at Equifax, and Benjamin Tal, Deputy Chief Economist at CIBC Capital, will deep dive into mortgage lending. Before we move into the key takeaways, Becky, do you have any questions for me?
Thank you, Sonama. Yes, I'm just looking. I don't see any specific on the mortgage side, but there are a few questions we can just quickly answer. So there was a question around how effective are current beacon scores adjusted for the fact that people haven't had a chance to spend money on credit cards over the last year and a half. Lower leverages would have led to a slight increase in credit scores that may not paint a true picture. So I can't comment too much on the Beacon scores because obviously they are FICO products. What I can tell you is that our Equifax scores, we have seen something similar. So we have seen those average scores increase. The thing to remember with credit scores is there are multiple factors that feed into those scores. So revolving balances are one of those, but there are many, many different elements that feed into scores. So what we have seen is that scores still seem to be rank ordering, but of course this is a bit of a period where we haven't had anything comparable historically. So it's always good to kind of look in a little bit more detail around what's going on with your portfolio, with those individuals. Are you seeing changes in terms of, are they changing their pay rate? Is there something geographically where there's higher unemployment levels? There are some additional things you can do to kind of make sure that you are using other methods along with scores to kind of really look at a more holistic view of consumers. There was a question on buy now, pay later. So do you see traditional banks competing in this space anytime soon? For example, do you see bank credit cards offering installment plans similar to PayBright through structured programs? So I know we certainly are seeing some lenders start to offer kind of hybrid products. So sometimes there are credit cards with installment components to it. So we are seeing that start to pick up a little bit. But again, this is kind of relatively new to the Canadian market. So I do imagine over the coming months, we'll start to see some additional products being offered by the credit card companies in response to some of that competition. I'm just seeing if there's anything else we haven't covered. I don't think there is. So I guess just kind of to kind of summarize what we've shared in this credit trends webinar for you. So we do really remain in quite a period of uncertainty when it comes to the credit industry. We've seen large changes in those consumer behaviours over the last 12 months, but that really could change as the economy fully reopens and we start to see changes in demand for credit products and potentially see increased spending on some areas. We do kind of expect it to be a bit of a K recovery though, so pockets of stress coming through, and therefore continuing to look at those different segments of your portfolio is going to be really important to manage through this period. So looking at those geographical areas that are more impacted, again, changes to payment behaviours that consumers are making, they really could be early warning signs. Interest rate rises that could come in the next 12 to 24 months, that's one that we advise watching as well. That could bring increased risk for consumer segments that are highly exposed, in particular on variable rate products. So again, learning from what happened in 2018, 2019, looking at where there could be pockets in your portfolio that might be more sensitive to that change in interest rates, and thinking about is there anything you can do proactively to take action to help reduce some of the losses that could occur if it puts strain on consumers. There is still that government stimulus support in place, and we do need to keep monitoring what happens as and when that pulls back. In particular, kind of those lower income part-time workers where we know perhaps some of the job security might be a challenge in the coming months, because some of those industries have really been coping for a long time now with kind of very limited ability to kind of really be opening their businesses fully. So that's kind of all I really wanted to share today. I want to thank you all so much for taking the time to listen to our webinars. We do enjoy doing these for you, but obviously we love the feedback that you give us. So if you do have any questions, comments, ideas in terms of how we can make these more useful for you in coming months, then please do fill out that survey. And as Swanima mentioned, we have a fantastic webinar planned in 2 weeks' time where Bill Johnson and Benny Towell will be digging deeper into what's going on in the housing market and looking at potential opportunities and risks that might come in that space over the coming months. So I strongly recommend attending that if you haven't signed up to it yet. It's going to be a great session. Please do download a copy of our presentation. I did see a few comments come through around sometimes with our On24 platform, we do sometimes get reduced quality on some of the charts and things. So please do download them from the section that's available to you, and all of the charts should be kind of a good quality in there. So thank you all very much for taking the time to join us, and we'll hopefully see you next time.